Okay, let's jump right in. We're focusing today on UnitedHealth Group, UNH. There's been some pretty significant movement recently.
Yes, definitely quite turbulent for them. Their stock value has seen a major drop.
How major are we talking?
We're talking levels not seen in 5 years, a really substantial dip.
Wow. And it seems like there are a couple key things driving this, right?
That's right. Two big pieces of news hitting around the same time. First, they've suspended their 2025 financial guidance.
Suspended guidance, okay?
And the second
is a change at the top. Their CEO has departed.
Okay, guidance pulled and a CEO change. That's a lot at once. And I gather this isn't just impacting UNH.
No, not at all. It's definitely having a ripple effect. You're seeing other big health insurers, their stocks are trending down too. It's shaking confidence across the sector.
Right. So before we get deeper into the why, let's talk numbers on that stock drop. How bad was it?
Well, the stock fell 12.8%. That's a significant single period move for a company this size.
12.8%. And you mentioned a 5-year low. Yeah, intraday, it actually touched $322.90. That's the benchmark we're looking at for that 5-year period.
And given UNH's weight in the Dow Jones, that must have had an impact there too.
Oh, absolutely. A stock like UNH dropping that much definitely puts downward pressure on the whole index. You feel it in the broader market.
Okay. And the other players you mentioned, Cigna, CVS, Humana.
Yeah, all trading lower in sympathy, essentially. When the biggest player signals trouble, it makes investors nervous about the whole group.
And this wasn't just a one-day thing for UNH.
Yeah, this came after several days of losses already. I believe it marked the 6th consecutive day the stock closed lower.
6 days. So there's sustained pressure here. What about technical indicators like the RSI?
Yeah, the 14-day relative strength index, or RSI, plunged down to about 14.
14, that's extremely low, isn't it? Usually below 30 is considered oversold.
Exactly. It suggests really heavy selling pressure, potentially pushing it into technically oversold territory. Whether that means a bounce is coming or just reflects deep concern, well, that's the question.
And the year-to-date picture. How are the shares looking since January?
It's not pretty. Year-to-date, the shares are down around 36%. A really significant deficit for investors who've held since the start of the year.
Ouch, 36%. Now, here's something interesting. Despite this performance, what are the analysts saying? Any downgrades? Bear notes?
That's one of the, surprising aspects. So far, no. No major downgrades. No flood of bear notes hitting the wires.
Really? After a 36% drop in pulled guidance?
It seems counterintuitive, doesn't it? Out of the, I think it's 24 analysts covering the stock, 22 still rated a buy, or even stronger, like strong buy.
22 out of 24 are still positive.
Yes. And crucially, there are 0 sell ratings right now.
0 sells. That's quite a disconnect from the price action. What about price targets?
Well, that's where the gap is really stark. The consensus 12-month price target is still way up there, around $549.91.
$549 compared to the current price around what, the low 300s?
Exactly. It implies something like a 70% potential upside from where it's trading now.
So the analysts haven't blinked yet, but that gap is huge. You have to wonder if those targets will start coming down if the price stays low.
You'd think so, right? That disparity suggests potential pressure on analysts to revise their outlooks downwards unless there's a sharp recovery. It puts their credibility on the line to some extent.
Makes sense. Let's quickly touch on the options market. What's the sentiment there? Are traders betting on a further fall or a rebound?
Interestingly, the options market seems still somewhat optimistic, or at least positioned for potential upside. Call volume has been quite high relative to put volume.
Calls being bets on the price rising, puts on it falling.
Correct. The 10-day call put volume ratio was averaging around 2.9, which is historically quite high, leaning towards calls.
And the volume itself was trading heavy.
Extremely heavy. On the day of the big drop, total options volume was about 8 times the daily average. Huge activity.
8 times normal. Wow. Any specific contracts getting a lot of action?
Yeah, the activity seemed concentrated around certain strikes. The May $300 put was very popular, suggesting some downside protection or bets.
Okay, betting it might fall below 300 by May.
Possibly. But also the May $360 call was very active too. So bets on a rebound towards that level as well. A lot of differing views playing out.
A mixed bag, but very high volume. Anything else on the options front? Volatility.
Yes, it's worth noting UNH has a high Schaefer's Volatility Scorecard, or SVS. It's currently 90 out of 100.
And what does that tell us?
It basically means that over the past year, the stock's actual price swings have tended to be larger than what the options market was pricing in or expecting. So it has a history of surprising traders with bigger moves than anticipated.
Okay, a stock known for exceeding volatility expectations. Good to know. Now, let's pivot to one of the core reasons for this.
Yeah.
The suspended 2025 financial outlook. Can you elaborate on that?
Right. So UnitedHealth formally announced they are pausing or suspending their full-year profit guidance for 2025.
Not just lowering it, but pulling it entirely for now.
Exactly. Yeah. And the reason they gave points directly to costs. specifically higher than anticipated healthcare spending by their members.
Higher cost? What kind of cost?
They said, and I quote loosely here, that care activity continued to accelerate, meaning people are using more healthcare services. And importantly, this trend broadened across more of their insurance products than they saw just in the first quarter.
So it's not isolated, it's becoming more widespread across their business.
That seems to be the implication. They also specifically called out higher medical costs for new members enrolling in their Medicare Advantage plans.
Ah, Medicare Advantage. That's been a big growth area, but also a focus for cost concerns industry-wide, hasn't it?
Absolutely. It's a huge part of their business, and managing costs there is critical. These higher than expected costs for new MA beneficiaries seem to be a key pain point.
And this isn't the first warning sign on costs this year, is it? Didn't they adjust forecasts earlier?
Good point. Yes, just last month they had already revised their full-year profit forecast downwards.
And the reasons then?
Similar themes. They cited heightened care activity indications back then too, along with expected reductions in Medicare funding levels. So this isn't entirely out of the blue, but the suspension of guidance suggests the problem might be, well, bigger or harder to predict than they initially thought.
So rising utilization and maybe some funding pressure combining, did we see evidence of this in their last quarterly results, like the medical cost ratio?
Yes, we did. The medical cost ratio, which compares the premiums they take in versus the medical claims they pay out, did tick up in the first quarter.
How much did it rise?
Well, overall premiums were up a healthy 11%, hitting nearly $78 billion. But their medical costs actually rose slightly faster, up 11.7% to $65.75 billion.
So costs outpaced premium growth, even if just slightly. That eats into margins.
Precisely. Even a small difference in those growth rates, when you're talking billions of dollars, has a significant impact on the bottom line.
Despite these headwinds, what are they saying about the future? Are they expecting this pressure to continue indefinitely?
They were trying to project confidence beyond the immediate term. They stated they expect to return to growth in 2026.
So they see 2025 as a particularly challenging year, but expect improvement after that.
That's the message. And they also reaffirmed their long-term growth objective, targeting 13% to 16% growth over the long haul.
Okay, so short-term pain, but long-term goals remain intact, at least for now. That leads us to the other major piece of news, the CEO change.
Right. CEO Andrew Whitty is stepping down. The company stated it was for personal reasons.
And who's taking over?
They've immediately appointed Steven Hemsley as the new CEO.
Hemsley. That name sounds familiar in the context of UnitedHealth.
It should. He's not new to the role. Hemsley was actually the CEO of UnitedHealth Group for quite a long time, from 2006 until 2017.
Ah, so a former CEO returning to the job. Has he stayed involved with the company?
Yes, he hasn't been completely away. He remained the chairman of the board after stepping down as CEO. So he's very familiar with the current state of the company.
Okay, so it's bringing back a known quantity, someone with deep experience leading UNH. What happens to Andrew Whitty?
Whitty isn't leaving entirely. He's transitioning to a role as a senior advisor to the CEO, so to Hemsley.
I see. What was the tone of the announcement? Hemsley's comments.
Hemsley expressed gratitude for Whitty's leadership, acknowledging it came during a challenging period for the company. He also sounded an optimistic note about future growth.
And did he address the current issues, the costs, the stock drop?
He explicitly pledged to get the company back on track towards those long-term growth objectives we just talked about, that 13% to 16% range. So signaling stability and a return to the prior strategy, perhaps.
It's interesting, this move of bringing back a former CEO. We've seen that elsewhere, haven't we?
We have. You think of Howard Schultz returning to Starbucks or Bob Iger coming back to Disney. It often happens when companies face significant challenges or strategic inflection points. Boards sometimes look to a proven, trusted hand from the past.
A safe pair of hands during turbulence. And UnitedHealth has certainly had some turbulence lately, even before this stock drop and guidance issue.
Yes, it's been a difficult period. There was the tragic death of a top executive last year, which caused significant internal and external reaction. And then, as we discussed, the recent earnings miss, which really kicked off this latest share price decline.
So a confluence of factors, operational cost pressures, leadership change, and recent negative events all hitting together.
Exactly. It creates a complex picture for investors and for the company to navigate.
Okay, let's try to summarize the key takeaways for listeners. We've covered a lot of ground.
Sure. So number one, UnitedHealth stock has plunged, hitting a 5-year low. Big drop.
Right. Number two, they've suspended their 2025 profit outlook because medical costs are rising faster than expected, especially in that key Medicare Advantage market.
Yes. And number three, CEO Andrew Whitty is out, replaced immediately by former CEO Steven Hemsley, who's tasked with stabilizing things and returning to long-term growth targets.
Right. Got it. Stock plunge. Guidance suspended due to costs. costs, and a CEO shuffle bringing back a predecessor, but they are signaling hope for 2026.
That's the company line, yes. They anticipate returning to growth next year, despite the current pressures. The market will be watching closely to see if they can deliver on that.
Absolutely. Well, this has been really insightful. Thanks for breaking it all down.
Happy to do it. It's a complex situation with lots of moving parts.
Indeed. And for everyone listening, if you found this breakdown useful, we'd really appreciate it if you could hit that like button and subscribe to the channel. It helps us keep bringing you this kind of analysis.
Yeah, definitely helps us out.
We'll be back soon with more analysis. Thanks for tuning in.
Thank you.